Lehuma Capital Market Analyst Viv Govender joins us now via Skype for more on that interest rate decision. Viv, thank you very much for joining us. Now, the Reserve Bank decided to keep the interest rates unchanged. What does this mean for the common man?
Well, it's obviously a positive in terms of not being a rate hike, despite the fact inflation is quite high. But that being said, I do think that the assumptions about the economic growth rate were disappointing. The fact of the matter is we are seeing that they are once again lowering what their expected growth rate for 2017 is going to be, and it's barely about 1% at the moment. If you look at the trend last year with regards to how growth was downgraded throughout the year, it's quite a bad sign in terms of the fact that we're starting at such a low base. And if there's any downgrade in terms of the assumptions for the year, then once again drop below the 1% growth rate for 2017 as well as 2016.
Now, speaking of trends, was this expected?
I do think it is expected to a certain extent because the market does expect that it's quite likely that in the near term we may just possibly see a rate cut coming through. That is based on the fact that the economy is really weak and therefore a rate cut would stimulate the economy. But that being said, with the inflation rate coming in higher than expected in the last reporting, even though we do expect it to come down later in the year due to the higher harvest due to the drought, we do still see other negative factors coming into play. For instance, the oil price is set to rise this year because of OPEC cuts. So if we do see oil prices rise, despite the fact that the drought has ended, we might just still see some inflationary pressures in the economy.
Now, is this decision likely to coax consumer inflation back into that 3 to 6% range?
Yes, look, I mean, I don't think we are going to see consumer inflation at that low point anytime soon, but frankly. I think that the Reserve Bank is willing to go at the upper end for quite some time just because growth is so weak at the moment. So they are able to basically withstand a breach of the upper end. But I don't think we're going to see 3% anytime soon unless we see a real strengthening the economy, also of Iran, or we see maybe oil prices drop quite significantly from here. But neither of those factors, I think, is quite likely at the moment.
Now, Viv, what about predictions for the rest of the year? I mean, we already know that economic growth has been predicted to be relatively low this year. What about inflation and the rest?
Yeah, the Reserve Bank does see, like I spoke before, that inflation is probably going to come down a bit. But still, I do think that they are seeing above the barrier inflation rate which is averaging for the year, basically. This is something that I think the Reserve Bank is willing to sacrifice some of its credibility with regards to inflation fighting, just because the economic growth rate at the moment is quite high. They did mention the fact that they're seeing consumers under a great deal of pressure. And that's obviously going to be something that they have to take into account when they're looking at raising interest rates. For consumers that are highly indebted, a slightly higher interest rate could make quite a big difference in terms of just their ability to survive in the economy.
Now, Viv, just finally looking at how interest rates look, what can consumers do to make things a little better to ease the pressure that you say they'll be under for the rest of the year?
Well, ideally, they should be looking to cut their borrowing and reduce debt, etc. But with the economic growth rate at 1% or just over 1%, it's going to be quite difficult for consumers to do that, considering the fact that they probably are borrowing not to have extravagant spending, but just to survive in certain cases. So it's quite difficult to counsel people to reduce their borrowing when they're not borrowing for to buy a new car or to purchase expensive furniture, but borrowing to do things like pay school fees or buy essentials, which is obviously a very negative reason to borrow. But I mean, it's hard to advise people on that. If possible, cut down on your spending so that you have actually more income than basically spending or expenses. Increase your savings, because the economic growth rate being as weak as it is could mean that you could face a tough period going forward.
Perhaps then another question would be, where's the best place to invest at the moment?
Ooh, that's quite a tough question. One note could be the fact that we are seeing some of the stuff happening internationally, especially with regards to some of the things that's happening in the US. Trump, the longer term is going to be negative for that economy, but in the short term, the moves he's making is going to be quite positive, especially for companies. Things like reducing their tax rates, allowing them to bring money back into the country at a very low tax rate. In the short term, probably is going to be a good move for that economy, and therefore you might see above trend improvements in the markets in the US, for instance. In emerging markets, things are very dependent on commodity prices. I do think that we might see a bit of a pullback with regards to the iron ore price, which would be quite negative for some of our bigger players out there, for instance, like Kumba Iron Ore and BHP Billiton. So some of the resource rebound we saw last year might not be repeated this year.
Viv, we'll have to leave it there. Thank you very much for joining us. That was Lehumo Capital Market Analyst Viv Govender joining us via Skype.